everyone. This is Abhijit Chatterjee and Rohan Singh. Welcome to our weekly session of Charts Are Fun. This is on August 16th after market close. Something historic happened in the market in the last few days. In fact, looking at VIX climbing up to 65 last Monday and collapsing below 15 by end of trade today. That's one of the fastest drop of VIX ever. Historically, this is just unprecedented. VIX has been around, if you look at stock charts from 1990, you're talking about like 34 years of VIX's history. This has never happened. A fastest rate of collapse of VIX, unbelievable. Well, the bulls are in control. Lee and Tom Bowley both have declared the bottom is in. Tom Lee has even further moved ahead and said that historically since 1928, market summer bottoms tend to happen in August and usually the first week of August. So that anecdotally coincides with historical data. And economic data is key. So let's just go look at the data, look at the charts, and see what's happening in the markets. So this is our blog site. The charts are fun.substack.com. We publish daily blogs usually in the morning. We request you to subscribe to the blog. It's free, just use your email, and every time the blog comes out, you'll be notified with an email on the blog. You'll notice that there's a whole set of blogs that was published. We talked about Walmart. Walmart actually had outstanding earnings, incredibly strong earnings, which in some ways was not a good indicator of really consumer spending. Consumers are looking for value. And Walmart said that it's not just the low-income customers, they've expanded now out to the medium to the high-income customers as well. Well, if medium to high-income customers are coming to Walmart, that likely indicates slowdown of spending, cautiousness in spending, something to really take in a cautious way, not something that is great to rejoice. While other retailers, price-sensitive retailers, high-end retailers, we know are all struggling. It's not. So we'll see what happens with Target next week. Retail earnings are all this week and then next week, and we'll see how they perform. So that's the blog site, and this is our YouTube site. The channel is Charts Are Fun. We absolutely enjoy charts. We consider it fun. We don't provide investment advice. This is primarily our patterns that we share, and it's just to guide you in investment decisions. We believe chart patterns have huge telltale signs about market directions. They have huge mystery to the markets. They actually tell stories about the markets, and we believe that it's fascinating how fun the charts are, and our goal really is to share these patterns and show it to you how fun these patterns are. So we request you to subscribe to the channel, and if you do like the videos, if you could hit the like button, we really appreciate that. This is Tom Lee. He was on CNBC this morning, and when asked about the markets, he did declare that the bottom was likely in. He said that the most common month for summer lows since 1928, as you can see right here on the top, is August, and this bottom, no different, happened in August as well, and within the first week. He did say that moving forward, he does see summer, we still have a couple of months left, kind of an escalator, right? We know that the market goes up an escalator and comes down in an elevator. So we had that sharp elevated drop, almost a 16% drop in NASDAQ. If you look at QQQ at 503 in mid-July, fell to 423. So that's almost an 80-point drop. 80-point drop out of a 503 top is roughly 16%. 80 points out of 500 is 16%. So that's what we got. We got a 16% drop in QQQ. S&P wasn't as bad. It was about 56.60 to 51.20. So that's roughly 540, 550 points. So that's roughly 10% is what the S&P 500 did. And then small caps actually had quite a big sharp drop as well. And they dropped closer to 15% as well. So now, if we look at what Tom Lee feels, he feels that the key is market is overreacting to the economic data. It got shaken up a bit. The Fed, first of all, on July 31st, indicating that they are not confirming the cut in September. They said they're going to be data dependent. Market didn't like that. Market wanted an indication of the cut. And then the day after, in fact, a couple of days after, on August 2nd, the July job data came out, unemployment shot up from 4.1 to 4.3. It's not just that 4.3 number, the kind of rate of increase and the way it's been climbing higher from almost 3.4% summer of last year to 4.3. And turned out the unemployment claims had shot up to 250,000 that same week. Those two data really shook up the market, thinking that weakening of job indicates a slowing economy and perhaps the soft landing thesis is gone. Markets started worrying about a hard landing. And then when we had the yen carry trade crash on the following Monday, on August 5th, it catapulted the market down along with the Japanese. Japanese market, of course, had a 12% drop, one of the crash kind of situations since 1987. US markets, in particular, technology got hit very, very hard. The Magnificent Seven got hit very hard. And that was just kind of call it a rubber band stretch, kind of a sharp drop. And then it recovered very gracefully from those levels. Last week, unemployment claims, just a few days later on Thursday, showed a trend, declining trend. From the 250, it came down, and it further came down this Thursday. So that declining of unemployment trend indicates that likely that July data, because we know that there was a Hurricane Beryl that happened in July, Texas got hit, over 1 million houses were without power. It's potentially possible that because of the shutdown in some of the factories and some of the jobs in Texas, that data kind of was poor in July to revert back to better trends starting August is what Tom Lee expects. So market kind of overreacted from that knee jerk and came back up just as strong. And Tom Lee feels that perhaps soft landing is back in the picture. And it's potentially soft landing effectively means that you get Fed is able to maneuver inflation down without causing a recession. That's what a soft landing is. You bring inflation down without causing a recession. So market is now beginning to be more confident. GDP end of July wasn't so bad for the second quarter. GDP end of July reported for the second quarter was 2.8. So GDP remains strong. Job market, if it was just the temporary kind of setback because of the hurricane, because of weather in July, and resumes its climb, then it could be good. That said, we know that there have been deep job cuts. Started off with news that we got from Intel. We had news from Cisco recently, and a few other companies have started kind of talking about job cuts. So that we got to see. Is that going to be a more pervasive thing? And are we going to hear job cuts from other companies as well? So Tom Lee today was quite bullish. He feels that the worst is over and market. And the other key thing that Tom did make a remark about was VIX, the rate at which and how sharply the VIX came down. Inflation data we know has been tame. Both came out this week. The PPI, usually they go back to back. PPI came out first on Tuesday and then CPI came the day after on Wednesday. We can see this is the rate of change over 12 months, which is the year over year change. And we can see that this is drastically falling, and now PPI is almost close to the Fed's 2% target. It printed, core PPI printed at 2.16. So that's all great. CPI is still little above the 3 handle, but drastically dropping, as we can see, from above 6.5. It is now at 3.21. That's the core CPI. But if you factor food and energy, the full CPI, that CPI is actually below 3. It printed at 2.92. So that printed a 2 handle. CPI is trending towards the 2. What's holding it back is shelter and auto insurance. And Tom Lee said that he feels that both will normalize. They just are stickier. They take few longer to come down than rest. In fact, the median prices, if you look at, are below 2%. It's just those two that are holding it above the above the 2.5 to 3% level. And Tom Lee feels that the auto insurance and the housing prices, the rents in particular, owner's equivalent rent will start coming down once we get mortgage rates coming down. So Fed funds rate is at 5.25 to 5.5, and Tom Lee is quite confident that we're going to get to see 4 to 5 cuts. That's the consensus. So 4 to 5 cuts would bring that back towards the 4%, and below 4, 3 to 4 is once the Fed rates come down. Tom Lee believes at that point we would expect to see rents, owner equivalent rent, the housing, to also come down, the cost of housing, and that'll help us in the inflation cooling down. He's been calling inflation to fall as a rock, and he seems to be pretty accurate in his prediction so far. Now, unemployment claims, interesting enough, has a seasonal trend turned out. Last year, summer 2023, we had a similar situation. Notice how from the 199, it had shot up to 261, fell to 231 from the early June timeframe to the July, shot up to again 258 by late July, and then drastically dropped from 258,000 to 202,000. So we see a steady climb up in a similar seasonal way as last year, this year as well, from a 194, printed the 250. That's when the market got really nervous. This was the last week of July. They always print weekly, so it's Thursday data, but this is high frequency. It comes out every week. So market tends to think that, sometimes this does not quite reflect the longer term patterns. But two steady back-to-back weeks from 250, it has come down. It has come down to 230 and then 233 to 227. So market will be watching next several weeks what's going to happen to these weekly unemployment claims. If they keep coming back down, that's a positive sign. It indicates that the the economy is not so bad after all. Another key tool to look at is what is the expectation of the Fed fund rate or the Fed interest rate cut in September. So there is the CME tool. It's a Fed watch tool. Probabilistically, it shows the cut probabilities. And we can see that a 25 basis point cut now is at 72.5% probability, and 27.5 is a 50 basis point. This had completely flipped, by the way. If you looked at this CME tool back on the day we had the market crash, the Japanese market crash and the US market collapse on Monday, the August 5th, this had shot up to 98% of a 50 basis point rate cut. In fact, there was a small probability of even a 75 basis point cut. And we know that Jeremy Siegel, the Wharton professor, made a big statement that he would have wanted Fed to do an emergency cut. Since then, of course, water under the bridge, market has cooled down, market is not as concerned about that. And even Jeremy Siegel has come back on CNBC and claimed that he overreacted. He's not expecting a 75 BPS cut at any time in the near future. That said, a 25 is looking quite probable, and we have next week is key to watch what happens in the Jackson Hole. Central bankers across the world will be meeting at Jackson Hole. It'll be very interesting to see how do they all convene, what do they all think about the economy. And Powell will be giving a speech on Friday. So market will be waiting with bated breath to hear what are his thoughts after the turbulent times that we've had the last couple of weeks, and then of course a recovery. What does he overall think about the economy, the jobs, and rate cuts? He never really will indicate for sure that he's going to do a cut, but he may start throwing some signals that maybe they're getting more and more closer towards a cut is what he might indicate. Now, this is the key drop that I'm talking about in VIX. Look at this. From a 65 level, it collapsed to below 15 in a span of 2 weeks. 65 was hit on Monday, the previous week, and in 10 trading days, it has come down to below 15. So if you map this out with a rate of change and use a 70 rate of change, you'll be surprised that's the sharpest drop ever. So if this is the rate of change on the top, and we can see that it hit, as of today, the rate of change for 7-day is minus 46. But if you looked at the day yesterday, that had fallen to minus 60. And you can look at, I'm panning out the kind of a long duration since 1990, right? 35, almost 34, 35 years of VIX since VIX has been around. You can see before 1990, there was no VIX. So from this data, we can notice that the rate of change has never been this low ever in the past history of the VIX. So that is a very interesting market history, or a market history forming pattern. And that indicates that the market really overreacted on that day on Monday, and now it's normalizing. And Tom Bowley made a very strong statement that VIX below 15 often indicates that any kind of bearish trends or bearish possibilities are literally over. Very rare for a bear trend to start off once VIX has collapsed from a peak down below 15. In fact, usually what ends up happening is it kind of has a downward trend and could start kind of coming back towards the 12. It has been hitting in the 11 to the 12 region. Recently, it had hit in the 11s, so it's possible that it could kind of come back towards that level, is what Tom Bowley expects. Now, the other thing to look at is 10-year yield, because that's at the end related to the inversion of the yield curve. You take the 10-year, you take the 2-year, you take the difference. That's been negative. People are expecting the inversion to uninvert and the 10-year minus the 2-year to start going positive. Now, 10-year collapsed, literally collapsed from 4.2. 4.14 was mid of July, and collapsed from, in fact, 4.29 to 3.66 or 3.67 in a span of 2 weeks. That's the speed at which a 10-year yield collapse. Since then, it has recovered to the 4.02, kind of forming a pennant shape. Technical patterns on a pennant is once you form a pennant, it's a consolidation. The breakdown is in the direction of the primary trend. What is the primary trend in the 10-year yield? Right now it's down from 44.93 in a waterfall way. It's been declining. In fact, 47.37 was the peak in April. So from 4.73 to 3.67, that's a more than 100 basis point drop that happened in the 10-year yield. And now it's kind of consolidating in a pennant shape. And if any indication of dovishness from Powell next week could perhaps resolve this in a downward direction. That's what the market will watch, because that will be very bullish for the small caps. On one hand, this is also safe haven buying of treasuries, money moving out of stocks into treasuries. That kind of rapid movement is caused by safe haven buying. Money moving, rotating out of stocks into treasuries, yields come down when treasuries get bought. That's a bit of a fear. But if this is kind of a decline because of dovishness on the Fed, market being more sure about the rate cuts, which helps the small caps, they're very interest rate sensitive, it could actually be good for small caps. Now, the long-term treasury ETF TLT, that's very interesting. That's the 20-year treasuries ETF. That's also forming a pennant. It has a classic inverse head and shoulder pattern. We can see that the neckline is around 94.5, 94.8. The left shoulder is 90.2. Head is at 86.18. The right shoulder is 89.5. Take the difference from the neckline to the head. That measures somewhere around 8.05. Add that to 94.23. That gets you to 102.28. So that's the target of the inverse head and shoulder, 102.28. It came very close to 99.93. Since then, it's consolidating into a pennant shape. So this resolution, this was also breakout on very heavy volume. So this resolution could be in the direction of the primary trend, which is higher. That's also something to watch. So if 10-year yield breaks below from its pennant, that would correlate with the TLT breaking from its pennant higher. So that's something, pennant is almost close to its apex. We will find out next week. And with it may not even wait till 5 trading days till Friday for that. Market may do something in anticipation, but very interesting to see what happens to the TLT and 10-year yield chart next week. Now, other thing that's very interesting is in this sharp recovery that we had, we did get an initial sharp recovery in Bitcoin from 49K to 62K, but then since then it's been consolidating. It's been kind of pulled back from 62 back to 56, has definitely maintained a higher low from the 49, but the key is to watch. If this bull market is for real and we're going to have a strong recovery, you do want Bitcoin to break higher. Now, if a Bitcoin breaks 62.7, that's measuring a level of 13.5 to 62.7. That takes it to 76.2. That's something to watch. Now, this is in some ways you could say a cup and handle. A cup from 62.7 to 49.2, the handle pullback to 56. So if that breakout does come next week, could be bullish for the stock market, could be bullish for the crypto and the miners and so on. Now, gold, on the other hand, had a beautiful breakout. Gold had a breakout today, reasonably good volume on the breakout. It was kind of range bound between 229 and 217. It had in the past formed a beautiful kind of call it an ascending triangle from 225 to 210. That's measured about 15 points to 225 is 240. So that's the target for GLD. We broke above 217 to 228. That's about 11.26 or so. Add that to the 228. That takes it to 240 as well. So in either pattern, on the short term ascending triangle pattern or the longer term ascending triangle pattern. Either of them measures to a 240. So expect continued upside in GLD. And one of the beneficiaries of this would be the miners that have been lagging a bit. Expect continued upside in GDX as GLD climbs towards the 240 target. S&P 500 had a very sharp V-shaped response. So we see that the waterfall decline from 5669 to 5119, that's literally a 10% drop. RSI came very close to 30, tested it. And when it came from the very close to the 200-day moving average, didn't quite test it, rebounded before it met the 200 and came back. On Thursday this week, when we got the unemployment claims, and we noticed that unemployment claims happened on Thursday and the retail sales. Retail sales were up 1%. Huge strength. Market was only expecting 0.4. So the strong retail sales and the unemployment claim coming down indicated softer landing, indicated a resilient consumer, and market rejoicing as a result, gapped higher. Gap higher in S&P 500 above it, jumped over its 50-day, 2 solid days of gains after that. But it's now, we will shortly talk about where we think S&P is headed from here, but it's kind of forming inverse head and shoulders, what we expect. The left shoulder has formed, the head has also formed. We would expect to pull back towards the 53.90 to form a right shoulder, and then from there breakout higher. That's what Tom Bowley talked about as well. Tom Bowley said in his video this week that he's expecting moving forward a bit of a consolidation, sideways pattern, and then a breakout later into next month. Perhaps after the Fed cut is for sure, market will then probably have a climb, is what he's expecting. QQQ actually wasn't as strong as S&P with respect to clearing its 50-day moving average. It had actually dipped below the 200. So we'd see from 503 to 423, an 80-point drop. That's a 16% correction. 423 to 475, 476, we notice is resistance. So QQQ is also added, but it's also near where its 50-day moving average is. So that's something for QQQ to observe. Is it kind of now come up too far too fast, have a pullback towards the 454 level to form its right shoulder, and from there resume its climb? If you look at XLK, XLK had a much sharper correction, 238 to 190, and fell way below the 200-day moving average. Why? Because a big part of the Magnificent Seven contributes to the XLK. And we'll show you the Magnificent Seven chart as well. So this got a lot below the 200-day, fell from 238 to 190. We are roughly talking about 238 to 190 is 48 points. 48 points on a 238 is more than 20%, 21%. So that's the kind of drop the XLK got, a lot more than even QQQ got. It is right at close this week, right at its 50-day moving average. Something, and also closer to the 220.7, 221 kind of resistance level. So 50-day moving average resistance, 221 as a resistance. This could also have a pullback next week towards the 210 level, and then maybe form a right shoulder and break out higher. That's something we're going to watch on XLK. Magnificent Seven has an ETF called MAG-S, and that one also had a nice recovery, testing its 200-day moving average to its 50-day moving average, and stopped right there. So we got to watch what happens to Mag 7s. The key thing is, again, there is not as much volume. The volume was much sharper when we had the drops. Volume not as strong in the recent climb from the 200 to the 50-day moving average. Something for us to watch. Small caps jumped over the 50-day, just like S&P 500 did. On Thursday, with the strong retail sales, with the data that we got, it had a sharp climb higher, and we can notice that this is now at key resistance, which is the gap down near 215. 215 was support, which is now resistance. It stopped right below it at 213.98. We got to see if small caps kind of have a pullback, and then with Jackson Hole on Friday, any indication of dovishness from FOMC, from Powell, could cause this to go higher. FOMC Chair Powell. So that's something to watch. But right now, we believe that it's maybe time for small caps also to have a bit of a pullback, maybe close the gap below the 50-day moving average near 208, and then from there, a bit of a consolidation, and then maybe the break higher. S&P 500 and QQQ, if you look at the hourly charts, this is where we see a clear inverse head and shoulder forming. The left shoulder is, so the S&P's neckline is near 55.60, 55.66. The left shoulder is at 53.90, 53.97, that level. Head is at 51.19. Came up to 55.61, 62 today. And then from there, we are expecting a bit of a pullback next several days to form its right shoulder, close out this gap right here that it left. There are two gaps actually we can see. There's a gap right around 54.50 and there's a gap around 53.50. We are not sure if the pullback will be as deep as towards the 53.50, but likely left shoulder matching kind of a pullback towards the 53.90 can't be ruled out. And that could actually be a buying opportunity for playing a breakout higher. That breakout, by the way, is a very bullish breakout. 51.19 to 55.61. You're talking about roughly 440 442 points. At 442 to 55.61, that's a 6,000 target. It's possible. There have been a few bullish folks. Tom Lee hasn't quite called the 6,000 yet, though he has long-term said 15,000 in S&P. But he has his target is somewhere in the 5,700 for the year, but he could definitely up his target if we do manage to get the breakout and S&P continues its climb. So that's something to look into. Is this going to turn out to be an inverse head and shoulder, right shoulder pullback towards the 53.90 and a break higher towards the towards the 6,000 level. QQQ is also forming an inverse head and shoulder. We can see that the neckline is around 476. The left shoulder is around 454. Head is at 423. 423 to 476, that's a 53-point difference. At 53 to 476, that takes it to closer to 529. So that's a possibility. There is negative divergence, by the way. RSI is at lower high as it's kind of consolidating at the 476 resistance. So on the hourly chart of QQQ, we're showing a potential pullback to 454, and then from there a climb and breakout higher, something to look at. So that's the expectation. With that, good luck, folks, trading next week. As I said, the key is Powell's decision or more of a decision is talk at the Jackson Hole. All the central bank leaders across the world meet, and Powell will kind of give some indication in the market about where he sees the economy, what are his thoughts about the kind of sharp drop that we got in the market, the volatility the last couple of weeks. With that, happy trading, good luck, and we'll meet you next week.